Crush the dollar or crush the economy? There's no doubt about it. The Fed is left with very, very few options that they'd like to pursue. Today we explore what's likely ahead for the rest of the year when it comes to yields rising and what it means for the dollar and the economy, as well as precious metals. So let's dive on in. Now, this channel provides global macro insights and champions the importance of sound money in a world gone crazy. So please do consider subscribing. So we can see that yields have continued to rise this week, and a bond sell-off which has really accelerated over the last couple of days. So let's explore the two options that are really available to the Fed and were highlighted by Luke Groman recently. First, destroy the dollar. So destroying the dollar really just focuses on the need for fiscal stimulus and the belief in the Keynesian multiplier. Now, the Fed still believes that this multiplier is far greater than 1, and therefore any dollar actually inputted into the economy generates a greater gain in terms of the economic benefit. Now, while that's highly questionable, that's certainly one option that they can pursue. And of course, this is straight out currency debasement via quantitative easing and the creation of new Treasury bills. Now, this would help to actually stimulate and generate more inflation as the currency is debased and the dollar depreciates in value. And that's, of course, good news for the actual real size of the national debt. And if that money is actually targeted in getting straight into the economy as well, then it may help with the velocity of circulation. And so what are the downsides of this strategy? Well, firstly, it's likely to involve some sort of degree of yield curve control where they need to prevent yields from selling off both at the short end of the curve, so that is at short-dated treasuries, as well as long-dated 20 to 30-year treasuries as well. Now, they would likely target an interest rate level where they would not allow bond yields to actually rise above for each of those different levels. But this is going to contribute to highly negative real yields, and this is likely to be very, very good news for precious metals because the generated inflation as well as those negative real yields. And we've seen recently that as the yield has actually risen, precious metals have suffered somewhat, particularly gold, of course, and there's a very strong historical correlation there. But there's also the potential for an inflationary impact on the stock market there as well, and that may cause some disruption to stocks, as investors recently have seen the stock market as a key means of actually obtaining some degree of yield, given that the 10-year interest rate hit 0.5% back at last summer when gold hit its high. And so what about destroying the economy? Well, this really just involves letting yields rise as quantitative easing and government spending picks up. Allowing yields to rise would provide some control on precious metal prices in the short term. It would seemingly contribute to some dollar strength as well, given that the US interest rate on the government debt would actually start to rise upwards as well. But each of these points reaches a critical inflection point where the interest burden becomes too great, and then suddenly gold, as a means to actually restore and rebuild the financial system, revalue debts and so on, becomes a real option, a real credible alternative. Moreover, rising yields can of course signify a currency collapse if the currency is going down while the yields are actually rising. That is something we have seen previously with emerging market crises, and this has been happening recently with the US. And the final positive point here is that it could help to actually cool the growth of leveraged stocks. So by allowing interest rates to actually rise, then it means that those stocks that have low current cash flows and really sold on the prospect of high potential future growth and have high debt levels, it would be far more costly to actually finance such businesses, and their growth would therefore be impacted. Now, the negatives of allowing yields to rise are, of course, that it will have an impact on the economy. It would also help to inhibit, reduce and stymie inflation, but it would contribute to a rise in debt servicing. And if we just consider the recent change that we've seen in the 10-year yield, where it's gone from 0.5 to 1.3%, in a recent podcast, Louis Vincent Gave was saying about how that reflected the actual size of spending on the US Army and Navy collectively. So the debt servicing cost of the interest burden would really become just untenable. And as yields rise, there's the possibility that there would be an impact on the stock market, given, as we've just said, that investors have been seeking out a yield from the stock market rather than from treasuries, given the higher returns that are available in the stock market. But there is one other alternatively, which was fascinatingly revealed by Kevin Muir on a recent Macro Voices podcast, and that is to unleash a tsunami of liquidity. And so how can a liquidity tsunami be unleashed? Well, one way is via the Treasury General account. Now, we can think of this as akin to a checking account for the government. Just a little bit of history on this Treasury General account. It was found after the 2008 financial crisis that there was a need for the government to have excess liquidity available to it. So these are Treasury bills that have already raised capital, but the money has not actually been used yet. And so we can see when Donald Trump took office in 2016, there was a height of around about 400 billion, which was actually available in this Treasury General account. They then sought to actually run that down close to zero, and that had quite a dramatic impact on the stock market, which rose at the same time. What subsequently happened that they raised a colossal amount of cash here, and we can see that currently stands at around $1.6 trillion. Now, there was a belief that this was going to be run down in advance of the election to create a feel-good factor for the economy as a whole, but that never took place, and so that has left Yellen with a huge cash pile which she intends to spend. And so she is looking at running down this TGA account by 800 billion over the next 2 months, and then take it down to a balance of about $500 billion by the end of June. And so this is a great flood of liquidity which is soon to be deposited into the economy. Now, currently, the Depository Institutions reserves, so banking reserves, amount to around $3.1 trillion, as we can see here. Now, there is the potential for the Fed to actually raise rates on excess reserves, as Muir highlighted, and that would then avoid the prospect of negative rates and the possibility of the disturbances and the disruption that this could cause for the banking system as a whole. So that would avoid negative rates on the short-term treasuries. But they may also choose to allow longer dated treasury rates to actually rise. At the same time, they would issue more debt on the shorter term treasuries and look to just roll these over as a permanent sort of debt rollover. And what this also helps to avoid is yield curve control, where they wouldn't necessarily be targeting a specific yield on different dated maturities. And so it's projected that the combination of QE and the rundown of the TGA account will add a further $2 trillion to the US economy by June. Traditionally, as we've said, what has happened when this has taken place is that risk on assets have gained, but it may contribute to some rotation in equities, where you see growth stocks perhaps sell off, and it could mean that financials and the energy sector may actually start to really perform. But what will it mean for precious metals? Well, it's quite difficult to say, because investors for the longer term treasuries would have the prospect of getting a true yield, which some believe could actually run to 6-7%, and the spread, the difference between the short dated treasuries and the longer dated treasuries could be absolutely substantial. And so depending upon how the US decides to actually finance its ongoing liabilities, if they choose to use more short dated treasuries, it does mean that they avoid the higher interest costs which would come as a result of the long-dated treasuries. And so what does this mean for precious metals? Well, long-term, I'm a real precious metals bull, and even in the short term, I think we've seen such relative strength recently with silver. And what we're also seeing is, of course, as the M1 money supply has now been discontinued, as well as the M2 money supply, is that the Federal Reserve is deciding to lie and cheat its way towards ensuring that we don't have clear overview over what is truly happening in terms of the monetary base. What does this suggest? Well, to my mind, it suggests they clearly know that inflation is really coming. And we know what they have done previously to inflation statistics to make inflation look so low. So to my mind, it makes perfect sense to hold inflation hedges such as gold and silver and other precious metals. We've also, of course, seen enormous gains recently with commodities, and copper has been on an absolute tear. Can they keep this show on the road, extend the current and accelerate the new system of CBDCs and try and hold everything together? It's quite some task they've got on their hands. It really is. What do you think? I'd love to hear your thoughts. Do let me know in the comments down below. Thanks so much for joining me, and I look forward to seeing you next time. Bye-bye.